Good day, everybody. It's Greg Schnell, and I am here with the May 11th edition of Market Roundup. Thanks for taking the time to join me. We have lots to cover off this week. The market setup was there, and a little bit of pullback with the trade tension. The rest of the world charts moved down significantly and hover around the 20-month moving average. I'll cover that off. Commodities fall under the 20-week moving average, so that's just an important place to watch for. The TSX was only down 1% on the week, which very surprising. It outperformed really, really well, actually. And then currencies had an inside week. Should be a week, not weeks. An interesting area. Bitcoin and gold and defensives played an important part this week. So let's get into the charts. So first of all, I want to cover off just what happened here. So these vertical bars are the options expiration, and next Friday is an options expiration. So let's just see where we end up there. It's usually can be an inflection point. As an example, December 24th low was right after it, and it was also a Fed meeting. The September high was also options expiration, and a few days later was a Fed meeting. Of course, we had the Fed meeting about 10 days ago, which kind of marked our top. So we'll just see if we get any more strength out of here, or if that just marks the final mark before the market rolls down. Anyway, the slope on this is more gradual. Obviously, I could have come off the lows, but I think this is a more important slope, and it sits closely with the same slope over here on the July to September high. So we're going to keep track of that. And the NASDAQ, here we have the pullback and bouncing right off this support line. So I think it makes sense that these two support lines are now the credible ones to use. This is the Fed options expiration, and we can see that we rolled over right near the top here. Big outside day helps a lot. In the background is the US dollar, and there hasn't been much information. Still a failed breakout from a couple weeks ago with the Fed meeting, and it's been gently pulling back, but nothing to really take sides on yet. So this is for the last month now. We were up 2% at one point in time. Midday Friday, we were down like 2.0 or 2.6% or something on the month, and that rally back midday helped a lot. So anyway, pretty much unchanged on the month at this point. Big picture going back to the beginning of 2019, that's how it looks. Let's just take this slider back a little bit and give you some more feel here. So still working on this top up here, and we're sitting right at kind of the levels we hit in January 2018, and sitting right on that level. So let's keep track of that. I think that's probably an important level of support that we want to watch, and I think if that starts to fail, this is a line chart, so it didn't show Friday's price action. But the concern would be that if it's going to pull back hard below this level, I think that would kind of mark our final tops that we're talking about. So anyway, keep that in mind. I think that's a little bit concerning, but so far it's an area of support. Obviously lots of outside weeks and lower highs and lower lows this week, but the Russell was the biggest outside week, and it actually tested new 5-week lows. So keep track of that. Again, that 1600 level is trying to hold it, just keeps oscillating around it. So we'll see if it ever gets the power to push through. And the NASDAQ spinning top candle this week after, and then the S&P pulled back, closed down slightly on the week, but it wasn't really as bad as you might have expected, considering the hopes for the trade talks. So so far momentum is very close to zero. Now the real question is, do we come down here and just gently bounce, or do we actually start to break down and through? And some of the markets, the momentum got quite weak. I will say we picked up quite a few distribution days over the last 2 weeks. So a distribution day is a down day with a higher volume. And so we had one here, another here, another here, and another here. So over the last 3 weeks, we've had 4 of them, and if we include this one on the 4th week, that would add up to 5. So definitely concerning. We need to be aware of that. And again, that's what we the data that we saw back here in October, it started to pick up when we had quite a few distribution days. And on those distribution days, once they kind of started to add up, that marked pretty rough October, November. You can see lots of red calendar days in there. And then obviously December with the big push. So continuing to watch those things come together here. I think the bigger issue is just trying to see what the fallout now is, that the trade talks are over with no resolution. Oh, one thing I did want to point out. I don't like it when this trend on the NASDAQ breaks and they start to underperform. Now, it's a week of underperformance, so let's not really get too focused on it. But again, back here, there was a long uptrend. Could just open this chart up a little bit more to show you that. And then let me just draw that on here. And the point I want to make is when this uptrend snapped, it was a pretty good place to be aware of. These slopes are slightly more aggressive so far. So perhaps we've got a little bit more weakness we need in order to see if this market's really going to break down. But the main concern I would just say is we're starting to show this trend in performance breaking again. And that was a pretty good clue near the September top there. So just be aware of that potential. Okay, I don't know that I want to go through all the indexes. Everybody's probably checked them all out. I did hear an interesting comment on CNBC on Friday, and one of the commentators mentioned that nobody uses the New York Composite, and I couldn't help but think differently. Tom McClellan has done a lot of work and found out that even though a lot of people are worried about there's bonds in there and a whole bunch of other stuff, a lot of McClellan's work showed that the New York Composite actually gave better results because it did kind of paint the picture of people moving out of one and into the other a little bit more clearly, actually. And so some of his summation index data and that kind of stuff actually worked better on the entire market than on operating company only. So I just want to point out that I would disagree with the comment on TV, and perhaps I'm wrong, but at this point I still think it's very valid, and the fact that it's making lower highs is still something to be concerned about. And again, this is a monthly chart going back a long time, but you can see in 2007 the October high up here matched the S&P 500. It doesn't always work that way, and so far we're making lower highs, and I think it's those lower highs that we need to be concerned about. And I do, hopefully I get time to cover off the foreign market charts. I do want to point out one thing, that when I went back and looked on the DAX, something that we could look for that would give me a little bit more optimism that things were going to improve. I had a friend who asked for me to switch from the cursor here to the arrow, so let me do that. Sorry. And this pulled back, and you can see we bounced right off the 10-month moving average, roughly the 200-day for the New York Composite. We're sitting here, again at the bottom of last month's range, so it didn't take very long for the New York Composite to take out the entire range of last month, and the Dow Jones Industrials have done that as well. Now we sit right at that level. We could finish way up here, and it'll just be a retracement bar where we went all the way back down and tested all the way back up. And that would usually be bullish, right? If you go all the way down and then finish the month near the highs, that comes across much more bullish, especially on a big bar. So we'll keep watching that, but right now I'm still not happy with this trend, and momentum tells me that things are getting weaker and has been getting weaker since 2018, so the start of it. Okay, here's the Russell. One of the things I'm watching for here on the Russell is, do we start to make new relative strength lows? And over here we turned over, and the Russell hasn't done anything really since then. We're back below that 1600 level where we topped out. And the Russell histogram continues to decline. Nothing really snapping down or anything, but again, our big worry would be that this rolls over right down here near zero, and that's got some big issues for us. And the Russell also bounced off the 40-week moving average again, and it is a downsloping moving average. So downsloping is not as positive as bouncing off an upsloping moving average. This is still trying to hold here, but again, when your general trend is down, watch carefully. These outside bars start to mean more. So I would just say definitely heightened our sensitivity to everything. Again, that trend line on the S&P is a pretty big area for me to watch for. What we're watching for now, so we had this big kind of setup where momentum was above zero and oscillating. We are just above zero now, and so if we rolled over here, this would be, usually that's a big problem area for us. So in 2015, that was the kind of thing we're looking for. So we continue to watch the momentum on this to just get a better feel for how things are going. So here's the Toronto stock market, and we're now testing the 50-day moving average, trying to hold above that. The 200-day is way down here, but look at our momentum curves here. These are all clearly messy. We did have a period back here in early 2016 where we had a lot more bullishness going on in the rally, but that's not the kind of rally that I feel like we're in. Anyway, we're going to find out more. And the reason I don't think that is because of the high-low data and the advanced decline data. It's already gone negative for Canada. Okay, so Canadian market here, just weekly momentum, what's going on, and it looks to me like we're rolling over. I am happy that it got above this green line, and so perhaps this just comes down, wiggles down, and then takes off to the upside, and that would be good. This is one thing that is a bullish thing for me, moving above the prior highs and the downtrend line on momentum. That suggests to me a new level of momentum, but doesn't always mean that. So anyway, I mean, of course, it doesn't always mean that. Again, we're using what we see a lot of, or one of the things that we see patterns replicate in the market a lot, and this is one of the things that usually helps set up a bull market where you've got a downtrend in momentum in place and you finally break above it. Now on this rollover, this is quite concerning, and there's two reasons it's concerning. One is it can be what we call a bear market rally, and what that means is the rally is steep and it tries to get everybody back in, but we don't get the participation. And then when it rolls over very hard and quick and doesn't let people out. So, so far this was a relatively minor pullback. And again, if this was going to be a new bull market, that would be helpful. We just haven't seen that from the advanced decline line data and the net new highs. Okay, just to quickly cover off other markets, the Shanghai really had a bad market hit this week, and there was the original tariffs put on, and somewhere in here there was another tariff package put on, and now this third one. So I need to go back and find that out, but I just thought I'd put it on here. But this is quite a down candle, obviously, and we can see the Shanghai is quickly losing its momentum here, everything rolling back over. And that was even with the China National Bank system moving in to kind of protect the market on Friday, up 3%. So the Nikkei is starting to break to new relative strength lows. I got some other charts on this, but again, this market continues to be the one that worries me the most. I just think that there's a lot of risk here. Anyway, this 21,000 level has held. I did have 21,250 on one of my other charts, and I thought that was interesting, but I've moved to this big round number on a whole bunch of them. This week, reset that level. I think that is one of the critical levels that we need to pay very, 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 very close attention to. I'm not going to spend a lot of time on the currencies because there really wasn't much that happened. I will say the uptrend in momentum on the PPO has now gone below my trend line. So that suggests to me more weakness here. This is the UUP, and you can see it's been a gradual, very gradual uptrend for the last year. And what we're looking for now is just to see, does this roll over? But there's a lot of oscillating in here where it just slowly grinds higher. And again, I'm still trying to figure out where money would move to if it wasn't moving to the US markets because they've outperformed everything else. So would surprise me. The euro, one big market here, just gently pulling back, and you can see the PPO histogram has now gone below zero, and this is just sitting sideways. So the real question is, do we get a sharp break in momentum, or do we just continue to grind sideways? Not much else. My Swedish krona hint box says we're going lower on the euro still, continues to just suggest weakness. The British pound, same issue, just kind of grinding sideways, but momentum is rolling over below zero, so watch that one closely. Japanese yen, not a whole bunch here. Again, an inside. Actually, this one had an outside week, and this suggests risk off, move into things like gold. We still haven't broken this downsloping trend line, so I don't want to get too concerned. We did move back above the 65-week moving average, which suggests caution for sure. You can get a sudden move like this in the end, so we'll just see. The Canadian dollar didn't do anything. This was a daily chart here. Here's the weekly. What you see on the week is we just kind of stayed inside the range of the last couple of weeks, so nothing going on. Flat PPO, haven't got a direction. But, looking quickly at the TSX, it does look like the tops are in place here. Australia, this is an interesting chart. This one just barely held above the December 2019 low. Otherwise, that would mark a new 3-year low for the currency. And you can see that there's a couple of other stabs down here back in 2015, 2016. So are we going to just break down here? And the PPO just rolled over this week. So on the weekly chart, this Aussie market looks very, very weak. And again, this is the copper market here in orange, and if copper is going to start to break down here, I think that's a big deal, and we probably see a lot more weakness in the commodity currencies like Canada and Australia. Here's a new chart I've added to this bundle this week. The chart list keeps growing. But this is copper with the emerging market currencies, and what you could see is a pretty tight correlation with the exception of a brief period in September here. And actually, as copper spiked, this currency fell, which is really odd, and then continued the uptrend with copper. But you can see that this is rolled over on a PPO sell signal on a weekly chart. So that suggests to me that we're probably going lower on our commodities and on currencies. Just to maybe review that. So here are the commodities for the week, and you can see it wasn't a good week for anything. Natural gas was the only thing that was up. I got stopped out of my natural gas, bullish natural gas trade, which was disappointing. But on all of these here, you can see rare earth metals, soybean, lithium. A lot of the industrial stuff is at the bottom here. Here's steel. Marijuana stocks had a bad week. So lots of things going on, and the agricultural grain sector is just getting pommeled. So again, these currencies confirm kind of the downward trend in commodities, and I think that's a bigger issue for us all. LIBOR had an interesting week. So this is the London Intrabank Borrowing Rate, and what we saw in the LIBOR was the first time it has crossed below the 200-day moving average or 40-week moving average in 4 or 5 years. 2012 was the last time it crossed down. Now, we can't really use that point because QE got put in right in around here, and this was all quantitative easing. This was quantitative easing in place, and we had a couple of starts and stops on quantitative easing. I don't know if this is the announcement of more quantitative easing or not, but maybe we'll keep watch on that. Here's the high yield market. So we're just on the bond market here. One of the things you see is this is unadjusted, so I backed out the yield, and what that means is there's this horizontal trend line that we've been watching, and what I'm concerned at here is we've had a failed breakout above this level, above the prior highs. Now we're moving below the 50-day moving average. The 50-day isn't that good an alarm bell for us. You can see a lot of times it chopped through the 50-day for a long period of time. It's more about the 200-day that I want to watch, and we saw in October as it fell below the 200, that was concerning. In January, it kind of failed at the 200. So we've got a little bit of room here. I don't know if we get all the way down there if the market was going to break before that. Okay, government bonds, they continue to climb. So that just suggests that more defensive posturing. We're back in a bull market on that after 2 years down. So that's one of the trend changes I'm starting to see in the bond market. This ratio of HYG to IEF is an important one for me. One of the things I noticed on here was back in 2011 when the European financial crisis kind of showed up, this was a big push down. In 2015, as we topped out in the stock market, this ratio touched the 200 from the underside and fell down. And here we are touching the ratio twice here in the last couple of months from the underside. So I'm wondering if this is now our new filter and this is going lower. And again, here's the downtrend on momentum. So rolling over under zero, not bullish. Saw this in 2015. So again, this chart continues to set up and suggest extreme caution. Again, on a lot of these bond charts, I didn't find a lot of interesting data this month. I think probably what was more interesting is how little they reacted. If we look at here's the U.S. 2-year, and you could just see that it's tilting down so far since the end of April. This is a monthly chart, but it's not really unloading yet. I will say that this chart is a big bearish reminder of past highs in place, and when this topped out. Now in this case it topped out whatever almost a year before. Well, here we've topped out late 2018, and so continuing to watch what this wants to do here. In 2000, it rolled over just above zero. This rolled over quite a bit higher, and we had the 2016 rollover that was, by the time it rolled over, the market was already recovering. You can see that down here. And maybe the same thing is happening right now, but it's this big RSI pile up here that suggests to me big things have changed. Okay. TLT, so this is the unadjusted TLT, and what that means is the yields are backed out, and you can see that this support line around 122 is trying to hold and see if we can rally, and the PPO is just gently touching here. This is one of the highest PPO levels in 2 or 3 years, so you can see back here as bonds continued to rise, it just kept pushing higher, so there's nothing to say it's all done here. So keep an eye on that. My BlackRock Muni Fund for helping us with the direction on treasuries continues to suggest higher. So every week that just keeps pushing higher. Monthly bond yields, so that was price, now we're into yields, and what we see here is this rollover, and so far we've had an inside month, came down and tested last month right on the lows and hasn't broken it yet, so let's check, and then we've got this earlier one from March, but you can still see the momentum trend is very steeply down, and we've got a lot of room to go to even get back to our uptrend level here, so keep watching that for momentum. This to me signals we're in a new bull market for the bonds, bond yields. So that should be suggesting we're going to go higher here after we get down to about the 40 level. Watch that closely. That would be a news changer for all of us for sure. Okay, here's the 10-year. The trend in yield continues to be down, and again the PPO looks like it wants to cross here, but hasn't yet. And look at this full stochastic momentum heading down, and you can see when it gets down here it can stay in this bear market environment even though there's some rallies in here, but the big picture suggests weakness here under 50, so I'm not giving this a lot of faith that we're going to get more than a bounce here. 5-year pushed to new lows for the month, and the only thing we have is that brief stab in March down to lower levels, but we've rolled over under zero again, so this continues to look very weak to me. 2-year, let's go down here to I just want to show some of these ratios. So this is my spread chart, and what this chart shows is all of the different bond yields. and how they line up. And it's after this compression that we're looking for. And you could say, well, we're compressed in here, but at the time, we didn't have everything on the right here, and so this compression here was pretty major. But in through this period of 1997-98, the market stayed compressed for quite a while. So are we there or are we here? And again, just so many triggers like that HYG chart and that kind of stuff suggesting some things are changing. But we continue to push down on this, drilling into the bottom right hand corner. And so what we should start to see is the 30-year hold up at a higher level, and all these other ones kind of fall away, and the shorter term yield curves actually go deeper and deeper and deeper, and then the 10-year kind of stays farther away but actually changes relative to everything else. So that's what we're watching for on the bond market. And again, this trend looks like it's ready to free fall, but just keep your eye on it. So here's the 10-year, the 30-year minus 10-year ratio, and this still hasn't broken through this line. I thought with all the action this week, it might actually get some enthusiasm. It really didn't do anything on the week. Up slightly. This is a daily chart over here, but we're still below the prior high from the end of April. Okay, I also put up this chart. This is the 5-year compared to the 30-year, and it might give us sooner clues that something was going on. And you can see, we're pretty close to the trend line in here, but there's nothing telling us that it's broken. And we did have one stab up through that level at the end of 2016, so I still want to be cautious. But, if these trend lines started to break, that would kind of confirm the fall. That would kind of confirm that this is actually starting to happen. So until those two trend line breaks, we're still on watch mode, the one on the 10-year and on the 5-year. Okay, transports. Ugly. We had a bad week in the transports. And I get it. The market is still near the highs, so no need to worry. But the transports are telling us the same story, and they had a bullish Friday. But a bullish Friday means that they went lower and came back up and closed near the highs of the day, but still ended up lower than the previous high or the previous close. So it wasn't like we had a reversal, but this is a pretty good hammer candle without question. On the daily, I do want to show you some big picture stuff. So there's a few changes on these charts this week that I rolled out. So this is the transports just on a 5-year picture. And one of the things to be watchful of is this Andrew Carswell work on the RSI, where it dips, where if it can't get above 60, that's a bear market. And so here, if the transports were going to roll over after getting up to the 60 level, that would be big caution. So we got a bear market signal down at 30, so that means that we should start watching if it tops out around 60. And sure enough, so far it has rolled over. We're sitting right here at 52. I think if it starts to wobble below 50, that probably is meaningful. Where did the transports finish? Written all over the two moving averages, the 10-week and the 40-week. The 40-week is at 490, we're at 602. The 10-week is at 596, and we're at 602. So right here with all the moving averages, pretty important place. You can see that we're making lower highs in momentum so far. And the transport momentum really pulled back this week. Wasn't a lot of people buying this stuff either. So one of the weakest volumes on the chart, considering the volatility. So they weren't looking here. And again, our big uptrend from 2016 is clearly broken. Come down, you have a rally, and then the rally comes up 3 waves and you start to break down. So all of the settings are in place for this to kind of fall away. And I think again, really want to be careful. We went below 0, considering that the next high would be kind of your final high to get out. That's pretty much where we're at now. So below 0, rally up, and your rollover is your next high, kind of your best place to get out. And until this got really rolling back above 0, there was no money to be made in the transports. Now, pretty important chart. All in all, we could draw a trend line here at 10,000, and that's kind of one of the important things on this chart this week. And why 10,000? Well, when we put that, I don't want that line that way. I want it a little thicker, solid, and I want it a little meaner, so I want it black. And this horizontal line at 10,000 was support all the way through here. So I think this is now a new level that we need to keep watching for. And if this is really going to break down, then that to me would be decisive evidence that this market does not want to go higher. Moving on to the airlines. This is a 3-year chart for the airlines, and you can see haven't done anything. Warren Buffett had added to airlines back in here, briefly got some money made, and you could just see chopped along. Now, he might be in one of the ones that's going up a little bit more than the others, but nothing really going on here. Relative strength downtrend, nothing happening that's positive. And when we switch this over to a weekly chart, no buyers showing up for work on the airlines. So I think this rolls over right away here. And the PPO rolling over at 0 with downtrending momentum is nothing bullish. Again, if this started to break out here, I'd get more bullish, like when it broke down in here and finally broke out. But I don't see that happening right now. So want to keep watching it. Our last signal was a bull market signal here, but we haven't made any money in this going back to November 2016. So hardly a place you want to have money tied up. The railroads. The uptrend got tested on Friday. We still have a little bit of this bearish rising wedge, and I had drawn it off the low before, so it was a little steeper, but I think this makes more sense. And this is a very long-term trend line that is kind of capping this off, so it's a bit of a back test. We do have lower highs on the momentum, and we've rolled over here, so this is now a bearish signal. But the trains continue to still outperform the rest of the market, the S&P 500, so that's a great thing. Here we are on the weekly, and the railroads are, everything is still up and to the right. We have no real sell signals on the weekly chart, so that's still bullish. But this is the one condition we have here. Next high has the potential to be a final high, and that's because we dipped below 0 after spending, almost 3 years above it. Now that we're back above 0, that I agree, it's still bullish. And what you want to watch for is this high, was this the fact that it let the railroads get that weak to actually give us a bear market or below 0 momentum? Be cautious on the next high that it doesn't just roll over. Now, this got up to such a high level, it still looks to me like the railroads have lots of enthusiasm, but it also says we're up near kind of where this thing usually tops out and pulls back for a little bit. Trucking, this is the one that's really gotten ugly. So here we are on the weekly view for trucking, and what you see here is this support level that was trying to hold up all through 2018. We're back to testing it and falling below. Momentum went below 0, has now rolled over at 0, and we got a sell signal this week. So trucking is really starting to fail, and you can see the volume spiking. And we've had horrific reports from J.B. Hunt, from CRH. C.H. Robinson, that's the one I'm trying to say. So that was another trucker that gave us bad feedback. And here we have the RSI stuck under 60 and rolling over below 50. This is a very bearish chart. This chart to me suggests a lot of weakness. And you can see the same thing kind of set up back here in 2015. You might remember the rollover into early 2016. That happened pretty much as this rolled over. So we're in a very cautionary place on trucking, again, trying to hold this 750 level. So that is really a tough one. Okay, on the autos, just continuing to drip into the right-hand corner. This is an outside bar on the daily, so that's a little bit bullish, and we're trying to bounce near 0, so that's a little bit bullish. I'm not that optimistic here. The Tesla chart is very weak, and Ford is one of the few charts doing well. Toyota Motors and Honda Motors rolled over. A lot of the auto parts companies I mentioned last week had tough weeks. A big company like Magna just got smoked So their chart was down dramatically, and if I get to it, we'll try and cover that off. Okay, so some of the other things just before we get into the commodity specifically, here's the broker dealer index, and you could just see, this the PPO is winding higher here, but again, just barely above zero, and the broker dealers are very good timing wise. They could help us a lot with being aware of market changes, and you can see that we barely got above the prior high and now have pulled back and tested a month's worth of work. We're still trying to hold above the 40-week moving average. I don't think we want to see this start to break down again. That would be a problem. And what we see up here on the RSI is it hasn't gotten up to the level, where it's going to start to push into a new bull market like we were back in here. So this is a more concerning chart for sure, and not really giving us the breakout we're expecting. Let me go cover off a couple of things here on other charts. So one of the things, this is the sector perf chart for the last 3 weeks. And what you can see is this is the relative value to the S&P. So communication services was marginally higher than the S&P, but overall actually lost money. So that's where you invest because of relative strength and then lose money because it still fell, but not as fast as everything else falling. And then here we have on the defensive side, staples, healthcare, and utilities. In absolute dollars, these are absolutely going up. And financials were actually holding up pretty good in here. Now, again, 3 weeks ago, I said, we started to have this problem where the defensives were taking over. If I spread this out to 20 days, what we start to see is communication services is still up over the 20-day period marginally, but these defensive ones were not. And that's my point, is that they're really starting to rotate into this defensive area. And if we go to 10 days, these areas were down hard and the defensives just held up. So again, trying to find something going up in a down market is hard work. And that's what this says here. All of the good stuff was really down hard and all of the defensives were, barely up. So, and then this is the rotation this week. So it didn't matter what you picked. You had a bad week. Staples, if you'd have just bought the XLP, you wouldn't have made any real money. So that would have been your best performer this week, and utilities were marginally down. So you'd have held up in a down market, but again, didn't make any money either. The healthcare got bombed. Financials pulled back 1.43%. So over the last week, financials didn't do any better than these other ones. Energy was a surprise that it held up as well as it did. It was a surprise to me, and I think that's the action in the Strait of Hormuz, where we have tensions building with Iran supporting the global oil price. Here's the chart of the FANG stocks, and the point I want to make here is, Amazon pulled back for the week, still trying to hold this level up in here, but again, after earnings, none of the technology stocks have really taken off. They've for the most part pulled back. And here's Apple. So it had its big earnings spike and it's been falling ever since. But still, here's your 200-day moving average just sitting flat. Here's Amazon's 200, marginally up but flat. Facebook has gently ground higher. It held up really, really well this week and has filled this gap now, and perhaps it could rally a little bit. But Google hasn't had any recovery after its earnings announcement. Netflix is holding up pretty well here. It made a new high here in May and gently pulled back to the middle of the range over the last 3 months. Microsoft had a nice push on Friday. It still continues to be one of the stronger stocks out there. And then we have Adobe that is pulling down and also had a good Friday. So we'll see if there's any price action in all of these. But when you look across, here's Adobe coming back to support. That would be a normal place to expect it to bounce from. Microsoft is just so powerful. You can see Netflix hasn't gone anywhere in a long time. And Google was just getting back to its prior high and then broke. And now here's Facebook after the big gap up. And we've got this kind of gap area, and then we had another area where we gapped here, and then a couple of months later gapped here, probably earnings, and now we sit here with this kind of island. So the question is, does Facebook hold this upsloping trend line or start to give it back? Okay, I did want to just show the banks here because the regional banking ETF is just hovering at the 200-day and again still continued to make a lower high. Let's go look at the KBE, so that would have the bigger banks in it. And this chart is sitting above its 200-day, so that's moderately more bullish. It's already made a rolling over on the PPO, so you've got a lower high in place on PPO, and I'll call it a flat price high, maybe a marginally higher price, but that's a little bit of divergence that we should be cautious with. I do want to point out the chart of Deutsche Bank because this is one of the big problems out there, I think. Here is Europe. This is Deutsche Bank in Germany. And what you see here is this $8 level is pretty important. We got down to 762 and we bounced off 763. So trying not to make new 5-year lows. So considering how close the market was to new highs, this chart continues to get weaker and weaker. So I think if all of a sudden this thing starts to accelerate down, that would be one of the places to look. Okay, I did want to cover off, I'll just do Bitcoin while I'm here, and the only reason is this chart is finally starting to perform. So this is the Grayscale Bitcoin Trust, and it was hovering in this $4 to $5 area, gapped up recently, and just kind of built the little box here, and now it's pushing out the top side of that. So I like it. Look at the PPO finally above zero, turning up above zero. This is really a nice entry, actually, and if this was going to start to take off, this would be a good place to look. Okay, so let's get in and go do the commodities now. I think there's a little bit more information there. I'll just show you the XLI because that's an important component. This was down below its 50-day moving average, obviously, on Friday, 10-week moving average, but it managed to pull back up and get back above it. But you can see this triple top formation here is a very big concern. So just watch this, especially on the weekly chart. If this PPO starts to roll over, I think that would pretty much confirm a market top being in. So far that hasn't happened, but we're right at that zone of resistance where it's an important place. And when I show you the rest of the charts from around the world, I think you'll agree. So here's CRB, Commodity Research Bureau, so a group of commodities all put into one index, and what you can see here is we're back down. We made highs last month and then pulled back down, but we continued to make lower highs and lower lows since the middle or second quarter of 2018. US dollar continues to test this 97.5 level, so I'm thinking if the dollar would go this way, this would go up. Don't know if that's going to happen, but to me it looks like the dollar wants to go up, not down. So this is a weekly chart of commodities, and I think that looks pretty much like spilled milk, just pouring down here, rolling over under zero, very bearish, nothing good about that. So if this started to base here, that would help, maybe with this February base, so it made at least a higher low or held that low, that would be good. It's not good that we got under this one to begin with, but the fact that we failed at the downsloping 40-week moving average also says this chart is full of pain, and be very, very cautious. So the rollover under zero is a concern. And again, if it just whips right back up here, then we'd get a little bit more bullish, but right now that's not what the message is of the market. Okay, DBC, this is a commodity tracking fund for the wide area of commodities. PPO momentum is now below zero, broke the uptrend line, trying to, it didn't really fall apart this week, even though the market was down. This pulled back. I would just say it didn't do anything great, so hardly a reason to run towards it. Okay, West Texas crude is trying to hold its 50-day moving average or 10-week. Nat gas is trying to push above it's here. Had my stop set a little too tight on my nat gas trade. And then heating oil rolling over at the top here. Again, just keep this 10-week in mind. And if gasoline starts to fall below the 10-week, this will be a series of lower highs. That's not that bullish. So just could be a better clue here in gasoline than in other things. Commodities can do that for us. So here's corn. breaking the uptrend line. These are all just horrific. Here's soybean breaking down. Here's wheat breaking down. Tough times for the farmers here. Gold and silver, nothing yet. And we're going to get into why I'm starting to get a little more bullish. I went through a lot of charts and then all of a sudden went, whoa, 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 I got to rewind and go through precious metal charts again. So it was the first time in a while. Again, the spider senses are tingling. We'll see if anything shows up here. Copper continues to break down below this horizontal support and resistance, and aluminum was pushing down hard. Aluminum actually on the daily chart looks a little bit better. Livestock breaking the 10-week moving average and this big downtrend line. It got above it and now is breaking below it. So it seems to be following the trend of livestock, which is not good. Sugar and coffee both had a bad week. Down here in the corner, I guess coffee was up slightly, if you can say that's up from this 3-year downtrend. And cocoa and cotton, again, they both got smoked. So cocoa came down. It's still sitting above its 10-week moving average. Look at the move in cotton. Kaplooey. So new 52-week lows for cotton. And there's an uptrend line here starting to come into play for cocoa. Medical marijuana ETF was down again this week. It's sitting right at the 50. A bounce here would be bullish. The PPO is tight together. It's not exactly falling and crossing like it did here. So there's still some hope for this area. I just don't know if it needs the overall market to get going, but I'd probably put a relative strength line on here. And if that could start to break like it did here, that would be a little more bullish. So there is definitely some areas in that market that are starting to look better. And again, there's a move towards edibles coming out in the next year. So some of that stuff is going to be a bigger play. Coal was down hard this week. Steel was down as well. These are industrial demand. So steel's at the lows for the year. Coal is at the lows for the year. That's not bullish for industrials. Here's lithium and rare earth metals breaking lower, low for the year, breaking lower, the low for the year. So these are all charts that are really stressing me out. I know, don't take it personally, Greg. These are just charts. But yeah, here's the energy complex, and what we see here is this PPO trying to roll over just below or near zero, so definite caution level. And we're quite a bit below the prior highs in the energy index. So this is an issue. We did get a bear market signal install at 60, so this is kind of textbook stuff. And when that happens, things get weak. So be careful here on the energy front. And the Canadian energy stocks actually look good. There's some political change and some tax change that might happen, maybe even a pipeline. So the Canadian ones look a little better than the U.S. ones, but I think it's mostly Canadian-specific issues, not global. Precious metals trying to bounce off the 40-week moving average. Another reason to at least be aware of it. But the second component of that is we had broken our downtrend, we roll up, and now we come down, and with this downtrend, we bounce off the zero level. And a PPO rolling up above zero would be bullish. Again, we got a bull market signal here recently, and this is trying to bounce at the 40-week moving average. So there's some reasons here to pay attention. Okay, there's not a whole bunch else here, but the one thing I will say is this, not livestock, that's not the one I wanted. I wanted industrial metals. You can see this is failing at the 40-week, whereas gold is trying to hold at the 40-week. This is not good. Look at the rollover on the PPO right at zero. I expect sudden acceleration lower here. Just energy, XLE, nothing going on really on this chart. It doesn't look as bearish, but this bear wedge suggests, maybe this is just coming down, makes a bear flag, and then breaks down again. So I'd just say lots of caution in the energy area. This crack chart got cracked, broke down very hard. This is the oil refiners, so new 2019 lows. PPO rolling over at zero. I expect this chart to break lower. Frac weekly, not good. Put in that high, tested the 40-week moving average rollover. We're still holding in the range, but again, this PPO looks like it wants to roll over below zero. That's just bearish stuff. Don't want to see that happen. You can see it back here. Okay, Frac Daily chart just grinded sideways this week, and I think that was on the back of the oil price doing the same thing. Here's oil for the week. Not really doing anything too much, but going below zero here, so potentially could start to see a little bit of a slide in the price. Nat gas, let's just quickly look in on that one. I can see we're not going to get all the way through this stuff. Here's the horizontal line at 260. So I'm going to pick up the pace a little bit here. And if you need to, you can watch the recording. But as we bounce out of here, if this starts to go, I think you want to be on board because natural gas can behave much more aggressively as a non-correlated asset to the S&P 500. Nuclear power plants, they were up marginally on the week. This is getting towards its lows here, so it might be a place to look for a rally. Looking at uranium, this chart is continuing to dribble into the bottom corner. But if you go look at uranium on a weekly, this is just at a very interesting place. And I pulled up CCJ. Oops. Not CJ, CCJ. And what you see on CCJ is we're right at the bottom of a big trend line going back here. And so if uranium was going to start to break out, we'd expect something from Cameco soon. They don't pay anything for a dividend, roughly a half cent or 0.5%. And the PPO is right at zero. So if this was going to bounce, this would be the place. It's on this trend line for the last couple of years. If it doesn't bounce here, I think you just let this one roll. There we are, uranium. Okay, let's get into, I already talked about copper, but just real quick, this chart continues to break lower, rolling over just above zero on a weekly chart. This is as bearish as it gets. That's not good. And be very, very cautious in the industrial metals. Here's steel. Cranking lower, PPO rolling over at zero. I had one chart for copper that I need to find because it was quite timely. Not this one. This one. Copper rolling over at zero. Boom, down we went. Rallied back up, rolled over at zero, down we went. Rallied back up, got right here at zero, and finally gave a failed rollover and turned back higher, and that was the place to get on board. Copper stayed up there for a year and a half, rolled over right near zero, problem. Getting up here, it looks like it's rolling over right near zero. So all of the trends suggest, I don't know, that this is not bullish, and just be very, very careful in the copper. Okay. Let's get straight to gold so that we cover this off for sure if people are interested. Okay, one of the things that happened, look at the gold volume this week. Big. It was nice and high. So even though everything else had muted volume, S&P and everything else, gold actually had a bigger volume come in on the week. So that was strong. We're testing the 10-week from below, but we're bouncing off the top of the 40-week. This is a great place to look for. And again, over here we went just below the 40-week and then took off. Same here. We have an upsloping 40-week coming down, bouncing off an upsloping 40-week is really positive. And again, PPO above zero, we'd like to see this work. So if this was going to work, this was December 2018, we actually got a pretty good push in gold. We just didn't get a follow-on from the gold stocks. Now, the full stochastic suggests this is just getting on board, and there's a relative strength trying to break out here. So next week is pivotal to watch. Okay, that's just the trend of gold versus the S&P 500 down. If this starts to break out, that's the relative strength trade, right? So we want to just see this actually push through. So this is gold coming down, and this is gold versus the S&P 500 trying to break out. Getting through here, really, really important. PPO suggests we're probably ready to do that right now. And the only thing I saw here was big volume for the last couple of weeks showing up on this gold continuous contract, and that looks bullish. And again, you can start to see that the volume is actually starting to turn up here. It's not as obvious on this one chart, but you'll see it on a few others that I've got coming up. Okay, so here's silent volume in gold for the last 2 weeks. This is actually GLD, even though the gold contracts were trading higher. Again, looks like it wants to turn up here. But look at this gold compared to the volumes going back here for multiple years. This is as quiet as it gets from 2016. We've had a couple of weeks down here, one in November. I don't think that is the Thanksgiving week, but and one in the August or September area here. But look at how that marked a nice low and off we went. And then anyway, sometimes these quiet volumes can tell you that for some reason nobody wants to sell. Well, it just gets quiet and then all of a sudden it breaks out with big volumes. So maybe we'll see that right away here. So it's another reason that I want to start to look in this area. Okay, moving on to the GDX GLD ratio, says we're not ready to buy the miners yet. So I'd watch for that downtrend to break, and if it did, you'd want to get on board. And again, this is all getting set up. It doesn't mean it's ready to, it doesn't mean it's breaking out yet, but some of the stocks behaved really well on Friday, like West Dome, I think was up 10%. Okay, so here's downtrend in relative strength, and we're trying to break through. That's the one I've shown you a couple different ways now. Here's silver. And again, silver PPO right at 0. Be nice to see what's going on. Look at the volume trend here. Briefly got lower than that at Christmas. A couple of weeks in January here as it stalled out at the top. But coming into this area here with nice quiet volume going back almost a year and a half. This is year-end volume of 2017. So if we can start to see any sort of an accumulation in volume here, that might be helpful. And SLV here, this is, so again, the previous chart was silver, the silver contracts. This is the silver ETF. And look at the lowest volume here. It goes all the way back, even lower than a little bit in February here, and then goes way back here to last November. Probably the Thanksgiving low 2017. So this is some really quiet volume here, and just want to be aware that that can be a great opportunity for a trade. So pay attention. I think there's some action setting up for the precious metals. Okay, this is the Silver Miners ETF on a weekly chart, and you can see we're coming down to test this big horizontal support level. PPO would be making a higher low here if it was going to start to turn, so that would be great. Let's just quickly stop. I'll show you this Magna chart just to give you an idea what's going on in the car parts business. We had noticed some things starting to break a couple weeks ago. Bang, down it came. This is a really hard fall, so I would avoid the auto sector in a big way. I think it's very risky here. The DAX on the weekly chart, again, one of the important ones for me. Trying to hold this 12,000 level. You could use 11,750, but again, big downtrend in place here and rolling over. The one thing I would say is if this downtrend starts to break, I think I have to get bullish, even if it doesn't make sense to me, because the chart's starting to change, and we're testing that level right now. So I really, you've got horizontal support as a place to bounce off. If it can't bounce, I think it explodes the wrong way. The reason I don't think that happens is that on the monthly chart, we're sitting right at 0, and we've got declining highs in momentum here, so I actually think this goes negative. And it's the fact that we broke the uptrend and are spinning down here, that I'm a lot more concerned. And so if this is going to break on the monthly chart, and this is just a bear market rally, then this would be the place we'd expect the stall, and we're right at the 20-month moving average, and I mentioned that in my opening comments. So here's the French market, also trying to hold there. But you can see came right back to the 20-month moving average. This is the monthly chart, same issue, broke the uptrend, have a little bit of a rally before it fails. Here it is on the weekly. This is clearly a fail from trying to test the prior high. Huge gap down, lost a lot. This thing fell 4% on the week, and that's after trading up on Friday, slightly off the lows. But momentum has rolled over, hasn't crossed its signal line. These are definitely ones to watch this week and just see where they end up. But they're definitely putting us on notice. Shanghai, really big place to fail on this chart. You can see we had the big 25-year uptrend, comes up and then fails right here. And we're actually trading below the 20-month moving average already on the Shanghai. So this would be bearish, and the PPO still below 0 down here. Hard to see, but we need to watch for which way this goes. But you can see that's a failed bar previous week, and then this week down hard, and the government came in and bought some stock on Friday to hold things up. Hang Seng's not going to be of any value, but the Nikkei, just to wrap this up, we're going to put